So we go to our last case, which is long-term capital management. I'm basing this case off of Roger Lowenstein's very famous book, When Genius Failed. You'll hear this book recommended many times in podcasts. It is a good book. I've heard Lowenstein speak on a podcast once. He's not a finance person, but he does have a good sense of finance, having worked in journalism in that area for many, many years. And he does a good job in this book of really covering the issues. So it's my only source for this particular PowerPoint because he does a good job, I think, of covering most of the things. I did have a little bit of extra source I'll talk about at the end from the Federal Reserve, but it's essentially we're using Lowenstein. So let's walk through it. The PowerPoint is out there. It was in Comic Sans script font. I changed this one I'm showing you to Arial just because Comic Sans just looks terrible nowadays, but I used to like that font. So sorry about that if you have to look at that font. Hopefully that's not enough reason not to do this as one of your cases for the final. So when we look at it, we got some famous people involved here, including some Nobel laureates. So in a strict sense, there wasn't any risk. According to what long-term capital management was doing, there was no risk based on their models. They had everything covered, mainly correlation. You're going to see correlation is a huge part of this risk. But that's assuming, as we saw with correlation, assuming that they're stable and predictable. But as we've seen and you saw in your risk project, correlation can change quite dramatically in a surprising way, especially in a crisis like we're seeing right now. So what is long-term capital management? A quick synopsis of the management because I think it's pretty important. The statistics review you don't really need, so we can jump through that pretty quickly. But we'll focus on the rise of long-term capital management. It's very interesting that their rise in the same year that Orange County goes under. So there's actually a relationship to that. We'll talk about the fall, long-term capital management, which is also pretty remarkable. Even in today's term, with the big numbers we saw in 2008 and now with the coronavirus, long-term capital was still a pretty amazing set of statistics on how quickly they fell. And then the focus of the case is on the lessons learned. What can we learn from long-term capital management? So the firm started in '94. Remember, that's right when Orange County is starting to have serious trouble. It is a hedge fund. So it means it's unregulated, pretty quiet, not transparent at all. They can only sell to high net worth individuals and institutional investors. They don't have to be registered. So you don't really know what they're doing. They use a lot of leverage, mainly coming from derivatives. So they may only be making 23 basis points, but they're leveraging it up 100 to 1, so they end up with 23% return. That's not atypical for hedge funds. Now, you may have seen in the news some hedge funds like Renaissance. James Simons has done extremely well this year. There are a few hedge funds that seem to be able to do what this firm thought it was doing when it started out, just make returns year after year after year with really, really well controlled risk. So that's great. James Simons had a great March. But then you see other firms like Dalio's, we talked about Bridgewater earlier, and Risk Parity, and his firm actually blew up here recently as part of the coronavirus nightmare. He also blew up somewhat in 2008 as well. But hedge funds, what does the word hedge mean? Hedge usually means you're reducing risk. And I don't think a hedge fund is reducing risk as far as the hedge fund itself. Some of these hedge funds are very volatile. What usually it means by hedge fund is risk is calculated and closely controlled. And secondly, hedge funds tend to be uncorrelated with other assets, so they tend to hedge the risk of other portfolios by providing diversification. Whether or not that's true or not, in 2008, hedge funds actually did really poorly. I mean, they did better in the overall market, but they were still down 20–25%. So, you know, it's questionable the word hedge really fits well. But they don't have to diversify. They tend to be pretty concentrated because most hedge funds are a small piece of someone else's portfolios. So most people don't have 100% of their money in one hedge fund. So Merriweather started this. Merriweather's a fairly well-known guy. Came out of I forgot the name of the firm. We'll see here in a little bit. A famous firm, Solomon came out of Solomon, used to be a famous firm, but went out of business. Um, but he wanted to focus on relative value trades, and his focus was in the bond market. So what he's looking at is a paired trade, and paired trades are fairly common approach for hedge funds. I missed one aerial. So pair trades is essentially you buy one thing, you short another thing. You buy the thing that's cheap, you short the thing that's expensive. They're usually highly correlated. So if they both crash, you're okay because the one you went long on goes down, but the one you're short on also went down. So pair trades is pretty popular in a hedge fund. So that's what we call a relative trade. You buy one thing, you short another. They were going to leverage up 20 to 30 times, or really they got even more than that over time. You'll see as part of their downfall is they got a little too leveraged. So they had to leverage it up because these spreads between bonds are usually not all that great. You're just talking basis points. So 10 basis points is not much of a return. You knock it up, you hit it up 20 times, and yeah, you're starting to get a decent return. If it's 10 basis points a month and you take that up 20 times, you're talking 2% a month. That's a good return. And so a very number-based company, very small company, but they had $100 billion in assets in 1998. So just in 4 years, right, 94 through 98, or I guess 5 years, just really quick growth. And because of its size, they were able to get really, really good lending deals from banks. In fact, there were people on Wall Street that were tripping over each other to try to get more money to long-term capital management. They also had this pedigree of really famous people working for them, and that just made people say, we want to have long-term capital management on our client list. The firm itself was paid extremely well. The partners received 25% plus a 2% charge on assets. So higher even than the 20, 22, or 21 that you see with other hedge funds. Very lucrative. So they got 2% even if the fund was down. So if 100 billion, they're getting 2% of 100 billion. You're talking $20 million plus 25% of profits, and their profits the first couple of years were huge. So these 200 employees were making a lot of money. Management, I mentioned John Merriweather is a math teacher, had an MBA. He was at Solomon. The bond world was very different in 1974. I was listening to a podcast by Roger Ibbotson, and he was talking about how well he did in the bond market in the 70s because he knew really simple stuff like duration. No one was talking duration. No one was talking convexity. And because Ibbotson had those things that are so simple now for undergraduate students, you've been using duration and convexity in your classes. But in the 70s, no one knew what that was. And so here you have this firm coming in with all these math people walking into a bond world that was very unquantified, very old school. And boy, they could definitely take advantage of it. Interest rates were really volatile. Inflation was really high. There was a lot of defaults. There were new exotic. We say exotic. We're talking things like mortgage-backed securities were coming into play. No one knew how to manage those. The computers coming online. William Sharp was a big push to getting finance to use computers. So this is perfect time for Merriweather to come in. He wasn't the only one doing this, but he's one of the ones, a small world of people. There wasn't a crowd of people doing this. So it was pretty small group of people, though a few really large firms were into this. His investment philosophy, let me fix another one here. Sorry. His investment philosophy was to gamble, but only when the odds were in your favor. And I agree with that very much. You say, does Vegas make sense? Would you encourage people to go to Vegas? I say Vegas makes perfect sense. I think Vegas is a great thing to do if you're on the house side of the gamble. If you're on the gambler side of the gamble, it's a terrible thing to do. But if you're on the house's side where the odds are in your favor, so all you have to do is have enough transactions that you're going to win over time, then yeah, that's a great strategy. So essentially what Merriweather was saying is we're Vegas, but we're on the house's side of the trade. So we can control this over time. And you will have some losses, right? Vegas firms, casinos do have losses every once in a while, but you just wait it out. You make sure the odds are in your favor. Make sure there's no one there counting cards, and you've got it made. So it's a calculated gamble, is what he's talking about. He started Solomon's arbitrage group. This was the model he took to long-term capital management. He had few competitors. He was forced to quit in 1991 because of a treasury scandal, and you probably won't remember this, but I definitely remember it. It hit the news. Solomon essentially was doing trades with treasuries that was not allowed. They were essentially becoming a monopoly on a certain securities, and Meriwether was not the cause of this, but he was the scapegoat, and so they forced him out. And that actually contributed to the reason why he was so secretive when he created long-term capital management. Hillebrand, you can see this, 2 degrees from MIT, very nerdy, control freak. And if you look at long-term capital management, they had 200 employees, but there was really a very small number of people like Hillebrand that were actually making all the decisions. Even people like Robert Merton that had Nobel Prizes in economics, they were not making decisions for long-term capital management. They were simply there to, as a showpiece. But obviously very well known in his field. He given instant credibility with other investors. And what Meriwether did by starting this fund was allow them to actually become millionaires versus just being paid professor pay. You can see at the end, the last quote definitely changed his life and his outlook. Myron Scholes, you can't get much more famous than that, Black-Scholes formula. But again, he was not a major decision maker for long-term capital management. Definitely his name, you can see these quotes, his name definitely opened doors. David Mullins, here you have someone who comes from the Federal Reserve, and so he gives them essentially the ethical side. Here's someone who, who's coming from the government side. He'll give them, a clean bill of health. Here you have someone from Washington that understands regulations. So obviously, this firm's being set up to play by the rules. And you see all these other people, all these MIT degrees. Very good with math. You can read through these on your own. They could download bonds, look at history, and get a sense of which bond was overpriced, underpriced based on history. Some market somewhere was mispriced, and their computers were going to tell them. So you look at yield curves, look at volatility, look at rates, look at spreads, and you can say, are there 2 securities that are inconsistent with each other based on what we know? So essentially what they're looking for is every price tells you something. It's a statement. And when that statement is inconsistent between 2 securities, there's an arbitrage opportunity. Now you say arbitrage in quotes because it wasn't truly a risk-free trade. It was more what hedge fund managers call statistical arbitrage. Over time it should work out, but it wasn't a sure thing. So he's looking for inefficiencies, and he believes spreads are likely, and this is a key, this third bullet is really key to long-term capital management. They believe that spreads on riskier bonds will narrow over time. So you buy the riskier bond, you short the higher quality bond, especially treasuries, and over time you'll win. We saw that when we talked about credit risk, when I showed you the probability of default times recovery and showed you that the spreads bonds pay are much higher than what is needed to cover you for default risk. And that's essentially their theory here. You get overcompensated with spreads on these type of bonds. They were really confident. They had a lot of people from academia. Meriwether trusted the models because he was hiring these really smart people. You can see this quote, "Don't you want to know more about my trade?" And Meriwether said, "My trade was when I hired you." That better not be your first job, or even your 5th or 6th job. Boy, in my career at USAA, I tried my best to surround me with people who would tell me I didn't know what I was talking about. Would jump on something, a mistake. And boy, I tell you, there's a trade in 2008 I wanted to do. The bond guys found out about it, and they told me immediately, "You're crazy. That's stupid. There's no way you should do that." And I'm glad they did. It would have been a horrible trade. They believe they're going to be richest because they were the smartest. I won't cover correlation. You already understand this. I'm not going to cover this part. We've already covered this, so we can skip this part of it. And so they started at the perfect time. 1994, Solomon just released earnings, and what they discovered was that section of Solomon that Meriwether was running was actually most of Solomon's profits. So Meriwether got this great press at the beginning of starting this firm, and essentially investors said, "Wow, this is where we got to be." They're trusting the history he had at Solomon. They're trusting all these Nobel Prize winners, all these MIT degrees, and essentially people were just blindly trusting this guy. 1994, as we said, it was a terrible year for bonds because interest rates rose so high. But Meriwether, he's starting now, so he's buying these bonds that are blowing up from Orange County and other places. He's buying them really cheap. It's good. I really recommend you listen to people like Howard Marks. Howard Marks has some podcasts about the bonds he was buying in 2008. It's great to be the only buyer in a market where everybody is selling. It's a great time to be a buyer if you have some guts. And Howard Marks talks about how stressed he was during that time, but those trades paid off handsomely. He was making 80-90% returns or more in 2009 after buying those bonds. So people are selling because they have to sell, not because they think the bond's mispriced. It's because they need cash. So long-term's buying in this distressed market. And everything they did was great. Banks had no trouble funding them, so they're getting cheap funding. There was people at Merrill being told by their chairman, do business with long term, and they said, don't worry about testing what they're doing, looking what they're doing. No one knew what they were doing, but no risk management whatsoever. No one, if you don't know what they're doing, how can you possibly invest with them? Well, look, the first year they made 28%. Remember, this is a year where bonds are down 15 to 20%. Long-term capital management was down 20% in 94, and yet long-term capital management was up 28%. After fees, that was still pretty good for their investors. Remember, they took 25% of that plus 2%. So after fees, their investors made 20% in a year where most people were losing a lot of money. In 95, they made 59%. Now, bond markets were up because interest rates dropped back down in 95. Bond markets were up 15-20%. So it was a good year, but long-term capital management was up 59%, and their investors made 43%. Incredible start. So no one knew about them in 1995, and yet they were already 2.5 times bigger than the Fidelity Magellan Fund, which is the most recognized mutual fund at the time. And they did it with very little risk. They had a value at risk, but they never hit it. They could never hit the standard deviation that they had targeted for this fund. They only had 1 month of a loss of more than 1%. Pretty amazing. And they were incredibly consistent over time. And that convinced them that what they were doing was right. There's some Taleb in here. Taleb talks about the worst trader is one who's been really successful because their trade is just the thing that's working. When their trade stops working, they're going to be losing a lot of return. But their actual return is only 1%. So almost all of their 59% return was due to leveraging up, which means small losses are going to be leveraged up to huge losses as well. So people are thinking they had this unique black box, but really everybody else was doing the same thing. It wasn't their models, it's the fact that they were more experienced and they were huge, which means they could get really good borrowing terms. So big scale, cheap borrowing. So what went wrong? Well, they had $7 billion in their capital account. That's not much when you have $100 billion in assets. Spreads had narrowed to very low levels. Remember, that's their bet. So they won that bet, but now spreads are extremely narrow. And we're going into 98. What did long-term capital management do? They returned money to investors. Essentially what they did, they levered up the firm. They say, hey, you know what? We don't want to be investing other people's money. We just want to leverage up our own money. So they were sending money back. Can you imagine some of the people they sent money back that were irate? They were mad. And then after long-term capital went under, they were probably relieved. They probably did what I said, that Orange County did. After long-term went down, they probably went to their bosses, yeah, I knew that was going to happen. That's why I took our capital back. There's probably some of that going on. So it just made them more levered. They started getting into places where they weren't familiar. It's pretty amazing what they were doing. They said, hey, our models work with bonds. They should work with emerging market equities. Should work with Russian debt. It works with U.S. debt. Should work with Russian debt. And they started doing things like risk arbitrage, market neutral, all kinds of things. They got heavy in the Russian debt, got heavy in the Brazilian debt, saying these two are uncorrelated. They even had a Bermuda-based reinsurance subsidiary, which makes no sense to me at all why they would ever do that. So they started saying, hey, you know what? Spreads are so narrow, we need to find other places to put our model in place. And so they got into places that had no experience. And there was people like Robert Merton and Scholes and others that were telling them, hey, guys, you're getting in places that are dangerous because you really don't have much history on Russian debt. And then you had what's called in 1998 the Russian debt crisis. Now, you can probably guess that going long Russian debt and short treasuries is probably not a good idea in a year known as the Russian debt crisis. So they lost 6.7% in 1 month. Remember, the previous worst was 1%. Credit spreads kept widening, the exact opposite of what they were betting on. The stock market implied volatility rose to 27%. They shorted that at 19, thinking, wow, the VIX is really high. In June, they lost 10%. So you can see quickly they're showing some big losses. Solomon started liquidating. So Solomon was another big trader doing the exact same trades long-term capital was doing. When there's only 3 or 4 people in a business and one of those is selling all the same things you're selling, you're in a lot of trouble. They underestimated what would happen if the big players were selling what they had. That's the liquidity side of this argument. Everybody's bailing out of Russian debt and buying treasuries. Guess what? They were long Russian debt and they were short treasuries, the exact opposite of what they were doing. Their partners were optimistic. They say, hey, you know, we didn't like these trades at the beginning of the year, and now that they've widened a bunch more, we should love them now. So wow, these are great trades. We should add more money to it. Let's double down. So they went outright long Russian debt, and they started betting all over the world. Russia declared a debt moratorium. Swap spreads, which we talked about, swap spreads, they were oscillating. They got up to 76 from 40. I mean, these are just amazing numbers. Usually swap spreads are only 2 or 3 basis points above treasuries. In fact, there was one period of time where swap spreads were negative to treasuries. August was the worst month ever recorded for credit spreads, at least up till 2008. There was a flight to liquidity. And they say we've never seen anything like this before. There were pre-experiences, maybe not exactly like this, but certainly in 92 and 87, there was something that at least would have told them that it could have gotten pretty bad. So all of their trades were being sold. Why? Because everybody knew they were in trouble. They were running from long-term capital management. So here's their daily VAR, $35 million. You remember what VAR means, how much you can lose in one day. I don't know if they had a 5% or 1% VAR, probably 5%. So they thought 5% of the time we could lose $35 million or more. $75 million was probably impossible. Here's their actual losses. They had a day where they lost over $550 million. They had another day. You can just look. This would have been absolutely impossible. Just like I showed you in class, you see these days that are almost impossible, or actually, according to the statistics, would be impossible. Pretty scary stuff. It was taken over 14 banks. The Fed didn't really spend any Fed money. No government money was spent, but they did step in to try to get people to bail them out. There was some people are upset about the Fed. I'll talk a little bit about that a little bit later in the next session. But essentially, long-term capital made all its debt payments and everything, you know, because 98 was short-lived. It came back, you know, all this worked out before the 2008 crisis hit. 99 was a pretty good year for everything to bounce back, so it came out all right. So the fund went under. I mean, it was essentially liquidated in 2000. Now, I will tell you, Meriwether started another fund after this. That fund went insolvent in 2008. So I did not hear of him going insolvent in 2018. So it's not every year ending in 8 that he goes under, but two in a row. Long-term capital management says it wasn't our fault. It was the market's fault. So the next session, what we're going to do, and this is really important to your case, is talk about the lessons learned. There's a lot of lessons learned here. So we'll start here next session and finish up our last class here talking about long-term capital management, which is probably, because you can see there's so many lessons learned, is probably a good way to close in the class on risk management.